There's a fund out there right now paying a 14% dividend yield. At that rate, you would only need about $421,000 to replace a $60,000 salary. Compare that to a boring fund yielding 2.4%, where you would need $2.4 million for the exact same income. So the fastest way to live off dividends is obvious, right? Take the 14%. Except it is not. And I'm going to show you the specific year, year 13, where the boring low-yield option overtakes the high-yield one and never looks back. Once you see that crossover, you cannot unsee it, and it changes what fastest actually means. Quick favor before we dig in. Drop a comment with the monthly dividend income you are aiming for. Just the number. I want to see what people are actually targeting, and it helps the video reach more people chasing the same thing. Like it if you're in. Let's go. Start with the arithmetic, because dividend investing is refreshingly simple math. Your annual income equals your portfolio balance times your yield. That is the whole equation. Flip it around and you get the number that actually matters to you. At a 4% yield, you need roughly 300 times your monthly income goal. Invested. Want $1,000 a month in dividends? That is $300,000. Want $3,000 a month? That is $900,000. Want $5,000 a month? You are looking at $1.5 million. 300 times your monthly goal. Write that down because it is the single most useful number in this entire topic. Now here's where it gets interesting because the yield is not one number. It depends entirely on what you own and the spread is enormous. A plain S&P 500 index fund yields about 1% right now. That is near an all-time low. And the reason is that the index is dominated by big tech companies that pay little or no dividend at all. A broad high dividend fund like VYM yields around 2.4%. A quality dividend ETF like SCHD yields around 3.25%. Realty income, the monthly paying REIT, is around 5%. Covered call funds like JEPI are up around 7.5%. And at the extreme end, something like QQQI is posting yields north of 14%. Watch what that spread does to the amount of capital you need for $60,000 a year of income. At VYM's 2.4%, you need $2.4 million. At 5%, you need $1.2 million. At JEPI's 7.5%, you need about $794,000. And at QQQI's 14%, you need only about $421,000. That is a six-fold difference in how much money you need. Same income, same lifestyle, 6 times less capital. You can see why people chase the yield. So why is the 14% not the answer? Because of where those high yields actually come from. Most yields above 6% or 7% are not generated by companies paying you a share of their profits. They come from covered call strategies, which sell away the fund's upside in exchange for option premium, or from heavily leveraged and REIT concentrated holdings. These produce a big headline number today at the cost of what happens tomorrow. 2 things tend to happen with those funds. First, the distributions are flat or shrinking over time rather than growing. Second, and this is the sneaky one, the share price slowly erodes. The fund is quietly handing you back your own capital and labeling it income. It feels like a paycheck. Some of it is just your own money coming home. Here is a real example of that erosion. The fund SDIV was paying about 21 cents per share monthly back in 2023. In 2026, it pays about 18 cents. 3 years later, the income went down. Now compare that to what a quality dividend grower does. SCHD's quarterly distribution was about 12 cents per share in 2011. By 2023, it was about 74 cents. That is a 6-fold increase in the payout, while the share price generally climbed alongside it. The dividend has grown somewhere in the range of 8 to 11% per year over the past 5 years. So let's put those two side by side on a $1 million portfolio, which is the open loop I promised you at the start. Option A, the 7% covered call fund. Year 1, it pays you $70,000. Fantastic. Year 5, still around $70,000. Year 10, still around $70,000. If you are lucky and it has not been cut. Year 15, roughly the same, flatline. Option B, the 3.5% quality dividend grower. Year 1, it pays you only $35,000, half as much. It feels like you made a mistake, but that payout grows around 6% a year, and the principal grows too. Somewhere around year 13, Option B crosses over Option A, and after that it does not just win, It keeps climbing while option A stays flat or declines. Meanwhile, the person in option B also has a portfolio that is worth significantly more than when they started, while the option A investor may be sitting on eroded principal. That is the crossover. That is why fastest is a trickier word than it looks. The 14% fund gets you to the finish line faster on paper, and then your income stops growing while inflation keeps going. The 3.5% grower takes longer to arrive, and then gives you a raise every single year for the rest of your life. So what actually speeds this up? There are 5 real levers, and only one of them is yield. Lever 1. Lower the number. This is the fastest lever available and almost nobody uses it. Remember the 300 times rule. Every $100 per month you cut from your spending removes $30,000 from the portfolio you need to build. Cut $500 a month and you have just erased $150,000 from your target. You did not have to earn it, save it, or invest it. You just stopped needing it. Think about how long it takes to accumulate $150,000. For most people, that is years of contributions. Trimming recurring expenses can do the same work in an afternoon. That is why this lever beats every other lever on this list, and most people skip straight past it because cutting expenses is not as fun as picking tickers. Lever 2. Your savings rate. The amount you invest every month is the engine, not your returns, not your yield. Especially in the first decade when your portfolio is small, your contributions are doing almost all the work. A portfolio at $50,000 growing 8% adds $4,000 a year. If you are contributing $1,500 a month, you're adding $18,000. Your contributions are 4 times more powerful than your returns at that stage. The market takes over eventually, but early on, the savings rate is the whole game. Lever 3. The yield sweet spot. Based on what the data actually shows, there is a range that most income investors converge on, and it is roughly 3.5 to 4.5%. Below about 3%, you are leaving current income on the table without enough of a growth advantage to justify it. Above about 6%, you start entering territory where you are trading away growth, taking on cut risk, or accepting capital erosion. A useful quality filter here. Look at the payout ratio, which is the share of earnings being paid out as dividends. Below about 75% generally means the dividend has room to survive a rough year. Above that, it is stretched, because a 10% yield is completely worthless if it gets cut in half next year. Lever 4. Dividend growth. This is the one that most people underestimate by a mile. A yield that grows 8% a year doubles your income in about 9 years without you adding a single dollar. Think about that. Your income doubles from doing nothing. That is the same compounding force that builds retirement accounts, except it is running on your income stream instead of your balance. This is exactly why the crossover happens at year 13. It is not magic. It is just growth compounding against a flat line. And it is the reason that the lower starting yield very often produces the larger income a decade out. Lever 5. Tax location. This one is basically free speed, and it is boring enough that most people ignore it. Not all dividends are taxed the same way. Qualified dividends, the kind you get from most traditional dividend stocks and funds like SCHD, get preferential tax treatment, somewhere in the range of 0 to 20% federally depending on your income. But distributions from covered call funds like JEPI and JEPQ are taxed largely as ordinary income, which can run up to 37%. So if you are holding high-yield covered call funds, holding them inside a tax-advantaged account rather than a regular brokerage account can meaningfully change what you actually keep. Same investment, same distribution, different amount landing in your pocket. That is yield you gain without taking on a single additional unit of risk. Now let's talk about realistic timelines, because I do not want to sell you a fantasy here. If you start with $50,000, contribute $1,000 a month, target a 4% yield with 5% dividend growth, you are looking at roughly 15 to 20 years to reach about $3,000 a month in dividend income. Push contributions to $2,000 a month, and you can reach $40,000 or more per year in dividends in roughly 23 years. Meaning if you start at 30, you get there around 53. Most people building this honestly need somewhere between 10 and 25 years. That is the real range. Anyone promising you dividend independence in 3 years is either selling something or taking risks that will show up on their balance sheet eventually. And one important reality check on the target itself. The average American household spends about $78,500 a year. To cover that entirely with dividends at a sane 3.5 to 4% yield, you are looking at roughly $2 million. That is why almost nobody lives entirely off dividends, and why the smarter goal for most people is partial coverage, dividends covering your housing, or your groceries and utilities, or half your expenses, with Social Security and other income covering the rest. Partial dividend income is achievable for a lot of people. Full replacement is a much smaller club. Quick note, everything here is the math of how dividends work, not advice about what you specifically should buy. The tickers I mentioned are just well-known examples of each yield tier. Your taxes, timeline, and risk tolerance are yours, and worth talking through with someone who knows your full picture. So here's the actual fastest way, pulled together. Lower your number first because that is the lever with instant leverage. Push your savings rate as high as you can sustain, because early on your contributions outweigh your returns. Sit in the 3.5 to 4.5% yield range instead of reaching for headline numbers. Prioritize dividend growth over dividend size, because growth is what gives you a raise every year instead of a flat check forever. And put the right assets in the right accounts so the tax code stops quietly skimming your income. Do all 5 of those and you will get there meaningfully faster than the person who did nothing but chase the highest number on the screen. And when you arrive, your income will still be growing instead of slowly shrinking. The fastest way to live off dividends is not the option that looks fastest in year 1. It is the one that is still paying you more in year 20. If this helped clarify things, send it to whoever you know that is currently staring at a 14% yield thinking they found a shortcut. That crossover chart might save them a decade.